What if the most powerful financial institution in the world, that institution that manages more money than the GDP of almost every country on earth, knows something about 2025 that the rest of us don't? What if behind closed doors, inside boardrooms we will never enter, analysts are whispering about a crisis forming quietly, slowly, invisibly, yet inevitably? And what if the warning wasn't meant for the public? Today's story begins with a mystery. A private internal research memo circulating inside BlackRock. It didn't contain predictions of total collapse. It quietly laid out a series of patterns so familiar, so eerily reminiscent of the months before past crises, that a single question began spreading through the financial world like wildfire. Is 2025 about to repeat history? But history doesn't repeat perfectly. It rhymes, twists, mutates. It offers clues, never answers. And what BlackRock's analysts allegedly pieced together is not a prophecy, but a pattern. A pattern that could reshape everything from stock markets to global debt to everyday life in the next 12 months. You may think you understand 2025. You may believe the headlines, the optimistic forecasts, the promises that everything is stable. But by the end of this video, you, LLC, why analysts inside the world, S most powerful financial institution, quietly fear that stability may be the most dangerous illusion of all. To understand why BlackRock's internal warning matters, you first need to understand what BlackRock actually is. Not the marketing slogan, not the headlines. The reality. BlackRock isn't just an investment company, it is the silent backbone of global finance. If you own a retirement fund, an index fund, or a banned ETF, chances are BlackRock touches it. Governments consult them. Central banks rely on their models. Corporations depend on their capital. At over $10 trillion in assets under management, BlackRock isn't reacting to the market. The market reacts to BlackRock. But power comes with responsibility and risk. When small institutions make mistakes, nothing happens. When BlackRock misreads a trend, the ripple can hit the entire global economy. This makes their internal research more important than their public statements. Public reports are polished, cautious, strategic. That's where the real concerns surface. And that's exactly why this alleged warning caught the attention of analysts worldwide. Because the memo didn't focus on headlines or current events, it focused on patterns. Repeating sequences in inflation, liquidity, corporate debt, shadow lending, and sovereign risk that if they continue pointing toward a pressure point in 2025. But to understand the pattern, we have to go back. Long before BlackRock existed, financial crises rarely begin with a crash, with the belief that nothing can go wrong. In the 1980s, globalization and deregulation opened financial markets. Money could move faster, debt became cheaper, and a new belief formed in the minds of governments and corporations. We can borrow our way through anything. This belief grew stronger through the 1990s. Then the dot-com bubble burst. Then the housing bubble grew. Then the 2008 crisis collapsed everything. Surprisingly, almost nothing. Corporations refinanced debt at near zero rates, and BlackRock expanded, taking advantage of the historic shift toward passive investing. Debt didn't shrink after the crises. The world built an entirely new economy on top of it, because according to the leaked BlackRock analysis, the seeds of the 2025 danger weren't planted in 2024 or 2020 or even 2010. They were planted in the 1980s, watered through the 1990s, fertilized in the 2000s, and now for decades later, those seeds have grown into something massive. A global financial system more dependent on cheap debt than at any point in history, but debt is no longer cheap. And that changes everything. From 2009 to 2021, the world lived through one of the greatest periods of asset inflation ever recorded. Stocks soared, corporate debt doubled, government spending tripled. But underneath that prosperity lay a dangerous assumption. Interest rates will stay low forever. This assumption created new financial structures. The BlackRock memo allegedly highlights its key vulnerabilities for 2025. Private credit markets exploding from $300 billion to nearly $2 trillion. Zombie corporations surviving only because they could refinance endlessly. Shadow banking systems quietly becoming larger than traditional banks. Household debt growing faster than wages, and government deficits expanding beyond historical boundaries. These were not isolated issues. They formed an interconnected web system optimized for low rates and constant liquidity. But in 2022, In 2023, the era changed, but the consequences didn't hit immediately. The real pain arrives only when refinancing begins. And according to internal analysts, 2025 is an unprecedented refinancing year across corporate bonds, government treasuries, private credit loans, and commercial real estate. The world is about to roll over trillions of dollars into higher rates. The alleged BlackRock warning doesn't predict a sudden crash. It predicts something worse: a slow motion squeeze, a tightening in credit conditions, a correction in asset prices. Not a single event, but a chain reaction. Here as the pattern, the memo reportedly highlights companies refinancing at higher rates and falling into default, consumers losing savings and reducing spending, banks tightening credit as loan books weaken, private credit cracks forming quietly, commercial real estate sliding deeper underwater, and governments hitting borrowing limits. Each step alone is manageable together. They form a synchronized pressure point, and according to the memo, 2025 is the year when all six pressures converge. This is not a prediction of collapse. It is a warning about structural stress, a warning that the financial system is more fragile than policymakers admit. But fragility alone doesn't cause disaster. Failure to fix it does. If these pressures continue unchecked, the memo outlines three major risks. First, a global liquidity drain, where borrowing becomes expensive and markets lose fuel, where governments refinancing at higher rates create instability and volatility. Third, a confidence crisis, the most dangerous force of all, where markets break not because of numbers, but because of fear. And fear spreads fast. The memo delivers its most chilling line. 2025 is not a crisis year by itself. It is the year when the margin for error disappears. Normally, central banks fix problems by cutting rates, injecting liquidity, or buying bonds. But the memo argues that 2025 is different. Inflation limits rate cuts, debt limits stimulus, political gridlock limits coordinated action, public trust limits aggressive intervention. The tools that saved us in 2008 and 2020 are weaker. Now, the world doesn't have the flexibility it once had, and this is the heart of BlackRock's concern. We have entered a period where traditional solutions create new problems faster than they solve old ones. Cut too slowly and recession deepens. Add liquidity and bubbles inflate. Remove liquidity and markets break. The global economy is stuck in a paradox that becomes visible in 2025. Look at the world's past: crises, 1997 Asian crisis, the 2000 dot-com crash, the 2008 collapse, the 2020 pandemic shock. Each began with the same ingredients: overconfidence, excessive debt, rising interest rates, mispriced risk, and delayed consequences. Each crisis grew slowly until suddenly everything happened at once. And according to BlackRock's internal modeling, the same cracks are forming again, but this time on a far larger scale. Never before has the world carried record debt, record asset valuations, low savings, and persistent inflation at the same time. We've seen pieces of this before, but never all at once. The memo IS&T claiming the world will crash in 2025, as claiming the world is entering a zone where mistakes have consequences, where policymakers don't have room for error, where investors don't have room for ignorance. The warning is simple: be prepared, not for collapse, but for volatility, instability, and accelerated change. The first takeaway is that the global economy is more fragile than headlines suggest. Stability is built on assumptions that no longer hold. The second takeaway is that debt cycles, refinancing cliffs, and liquidity shifts create slow problems until suddenly they don't. And 2025 is a year where small issues can become big ones. The third takeaway is that we aren't facing a single crisis. We're facing overlapping pressures: inflation, debt, liquidity, real estate, and geopolitical tension. The danger is in their combination. If the memo is right to then partially right, then the next 12 months may define the next decade, not because everything will collapse, but because everything will change. The real question is, are we prepared for a financial world where the old rules no longer work? If you want deeper breakdowns of hidden financial risks, leaked economic research, and the real stories behind the headlines, make sure you like this video, subscribe, and turn on notifications. Because the future isn't written yet, but the patterns are already here.